This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents, where we help you make sense out of all of those different decisions involving your dollars. So that's a pretty wide range of topics that we can hit and cover, and certainly in the show's 30-year history, well, we've probably pretty much covered all of them, I dare say. Probably all. Yeah, 30 years. 52 weeks, that's 1,500 shows, 1,500 hours. Yeah, that's probably, we've hit them all. But oftentimes folks need a refresher. So that's what we're here for. My name is Joel Garris. I'm with Nelson Financial Planning. And on the show today, we will, of course, as usual, kind of recap the week that was. Actually a pretty good week for the markets this past week. So we will recap that. We'll look ahead to next week as well. We will also talk a little bit about a employer plan that you don't often hear much about. You hear a lot about 401ks or 403bs or 457s, but you don't hear much about this one, and it certainly has its merits for smaller employers, and it is called a simple, which basically stands for Savings Incentive Match Plan for Employees, IRA, a simple IRA. So we'll talk a little bit about that on the program today. We'll also give you some estate planning musts, And then, of course, as is always the case on Sunday morning, you are welcome to add your topic of conversation into the mix by simply calling the phone numbers here in the radio studio, 407-916-5000, toll-free 1-855-545-1025. When you call the studio, our good man Rob, the producer, will pick it up and talk to you and make sure that you're all in good shape before you go on the air, so it's not just a cold arrival on the air, but that's what he does, along with putting the whole show together anyway. And, of course, you can also hit me up with an email. That email is my first name, Joel, Joel, at Nelson, Nelson for that, financialplanning.com. So Joel at Nelson Financial Planning. That's how you can get in touch with us and add your topic du jour to the conversation. If you recall last week's program, we talked a little bit about the process of how to project and plan for your retirement income. Almost half of the people out there within 5 years of retirement, according to a most recent survey, have not even thought about what that looks like. And we walked you through the steps of how you might start to figure that out. If you missed the program or you want to hear about those steps, we encourage you to look us up on all of the various social media channels, or just simply go to our website, which is, of course, nelsonfinancialplanning.com. And then there you'll find you'll also find the radio show too, but then you'll also find the various links to all the various social media as well. But if you listen to the program, we were talking a lot about how to go through that process. here's another statistic that even is more, I guess, interesting or unique. This was a Gallup Investor Index survey that found that only 20% of non-retired investors had calculated their future retirement income or expenses. So we got one survey that's saying it's 50% that haven't done it. This one's saying it's 80% that haven't done it. It's a lot of folks that have not done it. So we encourage you to think about what your retirement income is going to look and how you are going to get it. Again, catch last week's program to find out more about that. So the savings incentive match plan for employees, otherwise known as the simple IRA. It is a plan that you don't see very often, but it really is a valuable option for smaller employers. Specifically, to have the plan, you must have 100 or fewer employees. And of course, you can't offer any other plan. Okay, so generally, an up-and-coming business, kind of a growth stage business, if you will, 100 or fewer employees, that's the biggest parameter that you have to observe when you're looking at a simple IRA. And again, it's an employer plan. It's a plan that the employer sets up for the employees, and you must have 100 or fewer said employees. And what it allows you to do is it's not as high of a limit as your 401k, 403b, 457 world, right? Those will allow you to get to a much higher level, 18,500 plus another 6,000 if you're over age 50. Again, if you're in a 401k, 403b, or 457, and you're trying to max it out, know that those numbers have gone up. And particularly if you're over 50, that's an extra $6,000 that you could do. So it's 24,500. Obviously, that's a big number. On a simple, it's not as big of a number. On a simple, you are capped this year, and all of those limits are indexed for inflation automatically these days. So they will trickle up a little bit every 2 or 3 years, but the maximum in a simple IRA is $12,500. If you're over age 50, you can put in an additional $3,000. So that allows you to get up to $15,500. Certainly not $24,500 of a 401k or what have you. But the beauty of a simple is that you don't have to go through the cost and the startup and the regular IRS filing that you traditionally have to do on a 401k. Okay, 401k, there is an annual $5,500 that you've got to do in order to make sure that the plan is compliant with a number of IRS rules and regulation. A simple, you don't have to do any of that. Okay, there's no real startup cost or ongoing operating cost for the plan itself. So that's a great feature of it, again, particularly for smaller employers. The negative to that is that you do have a mandatory contribution, okay? So it does come with a mandatory contribution. You get to make that contribution if you are an employer in one of two ways. You can first match the employee's contribution up to 3% of the employee's compensation. So that means that you're basically matching, okay, 3% of the compensation, up to 3% of the compensation as they are contributing the money, okay? There's an option to reduce that 3% down to 1%, but you can't do that only as often as 2 years out of a rolling 5, okay? The other option is just to set it and forget it, meaning that it's a non-elective contribution of 2% of an employee's compensation, and that's it. So the negative to it, if you will, from an employer perspective, is that it does require effectively a contribution based upon either how much the employees are contributing or just a straight non-elective contribution. So there are some contributions that you as the employer would have to make. So that's sort of where that cost comes in. You don't have all the costs that would be typically associated with the 401k and all the administration and all the IRS and the forms and stuff like that and the testing and all that craziness that happens on a 401k, which is why traditionally you see those more and more only at larger companies, because it's very hard for a smaller company to really afford those costs because those costs kind of keep creeping up, which is oftentimes, if you're an employee, why you will see employers constantly flipping 401k plan providers, because they're always looking for somebody that can promise something cheaper than what they currently have, and why you see often where the traditional 1-800 no-load types of companies like a Vanguard or a Fidelity, where they command a very large part of that 401k space, is because of the cost-related savings that comes from that. So it's one of those pressures that employers are definitely feeling in terms of rising cost, that you wind up having a very much the cost associated with the 401k keeps going up. What can you do if you want to continue to do something for your employees? Certainly a simple is a very good way to be able to do that, because it doesn't have sort of those ongoing administrative costs. It does have, though, the cost of having to encourage or mandatory contributions in. As far as the employee is concerned, there is a little bit of a catch there, too, that if you are under age 59 and a half and you're trying to make withdrawals during the first 2 years of participation, you can, in fact, be hit with an additional tax of up to 25% on that withdrawal, beyond the 10% penalty for early withdrawal and ordinary income taxes. So it can be very expensive to take money out of a simple as an employee, particularly within the first 2 years of participation. But certainly one option out there for smaller employers that you don't hear much about, we thought we would spend some time chatting a little bit about this morning, just to get the topic out there. If you have a company or you work for a company with a smaller number of employees, and you're looking for suggestions and options as to what you can do as an employer to enhance your employee benefits, certainly the simple is an option that offers some cost benefits over the typical administration that you would have to deal with on a 401k. So certainly an option out there. So we put it out there for consideration. So we will slide to a break. When we get back from the break, we'll hit some estate planning musts. These are musts, not maybes. So stay tuned on that. You're listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. This is Joel Garris of Nelson Financial Planning. And if you'd like to join in on the conversation, the number is 407-916-5400. Toll free 1-855-545-1025. or you can also email me at Joel, Joel, at nelsonfinancialplanning.com. Those are the ways in which you can get in touch with us and add to the conversation your topic du jour, if you will, on this Sunday morning here in Central Florida. So the week that was, right? So tariffs continuing to dominate the headlines. Certainly on the beginning of the week when the announcement was made that another $200 million more in tariffs was going to come on board. And then, of course, early in the week, you also had the nomination of Brett Kavanaugh as to succeed Anthony Kennedy on the Supreme Court. Some articles out there already that discuss his views on business and interest and things like that. He does have generally, as you might well expect, considering his nomination from Trump, a record that suggests that he's pro-business. And so that will be obviously a big deal in the months ahead as we go through that process on confirming a Supreme Court nominee. It looks, well, he has gone through this process before with the Senate, so I'm sure there will be many headlines over this, but probably not a whole real big fight at the end of the day, because it's a guy with a pretty proven track record. Stocks certainly had a negative reaction to the tariff conversation, but then the focus shift, and the focus will really shift next week as we start to engage in earnings season once again. It is that time of year where in mid-July, companies start to report the earnings for their second quarter. Now, just to give a perspective, for the first quarter of this year, with two different things at play, obviously the tax cuts starting to come into play, the spending bill that was passed in Washington in February. Those two things sort of were coming online in the first quarter. As a result, you saw a pretty nice jump in earnings, nearly 25%. The average company in the S&P 500, which is generally viewed as the 500 largest companies in America, quarter one earnings grew by 24.8%, while the top line revenue advanced 8.5%. So top line advanced by 8.5%. Earnings grew by 24.8%. That's some pretty strong numbers. What is expected for the second quarter? Kind of more of the same. Another 20% earnings growth rate and another top line revenue growth rate of 8.4%. Both pretty good numbers across the board. And so when you look at those numbers, and the market started to look at them this past week, then those trade tensions really sort of fell to the background, if you will. And so for the week, it was actually a positive week for the market. The Dow was up over 2%, the S&P 500 up 1.5%. So the Dow, which is sort of what everybody looks at, but as we've said before, the point increase doesn't matter as much as it used to. But for the week, the Dow put on close to 600 points. So a good week in the market, despite the auspicious beginning of the trade headlines. Clearly, there is a thought of looking ahead to earnings, and that is the primary focus. Certainly seems to be based upon the overall market performance. What's interesting, though, is that there is definitely a situation where there are winners and losers in the market, because if you look at what's ultimately really driving the market, it is, in fact, companies like that are more on the consumer staples side of things. Meanwhile, if you look at those types of companies that could be more affected by a trade issue, like financials, like industrials, things like that, those types of companies have actually seen their share prices fall anywhere from 2 to 3%. So there really is starting to be in the market as a whole this difference of winners and losers, and how that ultimately shakes out. So certainly something to watch for the road ahead. But clearly the week ahead, big earnings week across the board. And then also, if you're paying attention, tomorrow is Prime Day, which whatever that means. So it's Amazon Prime is basically extending its shopping and giving members 10% off at like Whole Foods markets and things, or maybe it's like a credit or something like that. My wife was talking to me about it this morning. She's like, "Oh, we got to go shop at Whole Foods today." I'm like, "I've been going to Whole Foods because we get like 10% credit on Amazon." And she knows that I have an Amazon addiction because I order from them an awful lot, because I just don't like going in and parking and walking and then waiting and then finding and nobody's there to help you anyway. So anyway, I have an Amazon addiction, I confess. But so anyway, tomorrow is Prime Day, which means that you can get some credit on your Prime if you spend money at Whole Foods or whatever. It's fascinating foray, as we've talked about on a prior program, Amazon getting into the grocery side of things. And then the other week we were talking about them getting into the prescription pill business side of things. Certainly the kind of incredible disruptor out there that history is full of, as you have seismic changes in technology or approach, then ultimately it has a ripples effect. And certainly there are winners and losers across the board. Toys R Us, obviously, one of the losers as a result of Amazon's dominance in the consumer staples and consumer goods space. So certainly an interesting week ahead, as it always is, even though it's July and it's summer and it's relatively quiet. There will certainly be much to look at, particularly during the course of the earnings that will come out this week. So I'm sure we'll have much to talk about next week on the program. We're at the bottom half of the hour, so I'm going to slide to a break, and then when we get back, we'll talk about the estate planning must, some things that you really want to be doing as you go through your estate plan. I'm also going to share with you a conversation that I had with an attorney that was fascinating, because it really sort of cemented one of my widely held views of what happens when people try and go through the estate planning process. So stay tuned for that here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5. Sorry, I was in the process of reading the conversation, and we actually got a email. So it's hard to. I'm going to read that during the break, and then we'll talk in the next break. We'll talk about that, so the estate planning must will be what we will cover in this topic here on Dollars and Cents. This is Joel Garris, News Radio 102.5 WFLA. Certainly, there are a variety of estate planning musts that are very important to consider when you are thinking about your estate plan. I'll share first a conversation that I had this past week with a lawyer who winds up being basically helping to cement a perspective that I have had for many years, which is that the vast majority of people out there have basically been oversold a trust document that ultimately doesn't really do anything other than generate a big fee to the estate planning attorney that is preparing it. Let me say that again. The vast majority of times, people that have a revocable trust don't really need it. And they usually wound up with a 40-page document of which they paid a bunch of money to ultimately wind up being given a document that doesn't really do anything that they couldn't have accomplished in much simpler and zero-cost methods. What are we talking about? Well, a lot of people have this notion that a trust is necessary for liability protection. In fact, in the state of Florida, a revocable trust does no such thing. It doesn't layer on some additional liability protection. A lot of people are under the misimpression that a trust will allow you to avoid probate, and that's the only way that that can be done. Again, yes, a trust avoids probate, but at the end of the day, it does not. It is certainly not the only way that that can be done. There are far more cost-effective, as in zero cost, that ultimately you wind up being very much a cost savings when you are simply doing things like adding beneficiaries to an account. When you add beneficiaries to an account, there's no cost to that. That's usually just a piece of paper. When you do that, effectively, you wind up avoiding probate. So one of the biggest features of having the trust is, you're going to avoid probate. You can effectively accomplish just by completing a piece of paper that your bank is going to have, or your financial institution is going to have, or your mutual fund company, or your 401k, or your life insurance, or your annuity. The list goes on. All of those will allow you to set up directly named beneficiaries. And when you do that, then you avoid probate. So you don't really need the trust to avoid probate because there's a bunch of other ways in which to do it. So a fascinating conversation with an attorney this past week where we kind of got into that philosophical conversation. And it was nice to hear somebody being basically cementing the perspective that we've had for many years now, which is that oftentimes a trust is not warranted. A trust can be warranted where there are some stipulations that you would like to put on that money after you go. Maybe you don't want it all distributed out directly to your beneficiaries for a variety of reasons, chief among them, hey, they may do stupid things and spend the money, within the next 6 months. But the reality is that more often than not, a trust just simply says, well, I'm just going to leave it to my two kids evenly. Well, could have done that with some paperwork that was freely available throughout, adding things on like a payable on death, adding things on like a transfer on death, or just simply filling out beneficiary paperwork on an account. All of that also avoids probate, and of course, the cost is zero. Some of the other things that you want to be thinking about along those lines is certainly to make sure that your will is reflective of the events that are occurring during the course of life. Sometimes your will refer to your house as a physical location, and or it will refer to people, relatives, and you may move, folks may pass away, you may have a falling out, you may get divorced, and ultimately that's why it's important to sort of update that will on a regular basis, and that doesn't mean every couple of years. I mean, think of it as something that you want to review, every 5, or maybe if you want to go longer, every 10 years. But it's important to update it to reflect the realities of the situation at hand. And when you're reviewing it, one of the biggest things that you want to be looking at is who are going to be the decision makers after I leave. So that would be if you do have minor kids still, then you would want to know that the person that you've named to be the guardian of those kids is still the person that you would want that to be. Similarly, with your personal representative or executor, is that still the person that you want to be? Those are the people that are going to be carrying this stuff out. So it's important to kind of review those and reflect upon who it is that you have named to make sure that that is still consistent. Another thing to think about when it comes to estate planning is looking at a living will. A living will would wind up being a document that would basically give somebody, again, that decision maker, the ability to ultimately detail what sort of medical steps, what is supposed to happen when it comes to those sort of end-of-life decisions. That's the point of a living will. Along those same lines, a healthcare surrogate is when you're not in an end-stage condition, but you're giving somebody to make medical decisions. That would certainly be something you'd want to make sure was up to date, along with a power of attorney. The power of attorney basically deals with business affairs. So those healthcare surrogate living will, generally more health-related. Power of attorney is a document that deals with financial and business-related stuff. That one you certainly want to be very careful on as well, because you don't want to give somebody a power of attorney and then you get ill, and then they basically take the money and put it all in their names. And with a power of attorney, a general durable power of attorney, that they could do that. So you have to be very careful with who exactly you're naming as these decision makers, which is why it's important to review them every few years, is just to double check and say, okay, I'm still comfortable with Johnny being the guy in charge. So important to review and to look at that. And then from a tax perspective, certainly it's important to kind of look at this from a tax perspective, particularly if you've got retirement assets, particularly if you've got anything that is on perhaps an annuity basis. Those types of accounts carry with them some tax implications for your beneficiaries. So you certainly want to make sure that those accounts are set up so that at least your beneficiaries have the option to be able to extend out the payout of that money over an extended period of time. And then that way you don't have to have all of that payout all at one shot and generate a sizable taxable consequence. So it's important particularly on those retirement accounts to get a tax angle on the estate planning as well, because there are some assets that can create some tremendous tax liability, particularly in the form of retirement accounts and the like. So certainly some important things to be thinking about, not just estate planning, but also tax planning. The other thing that we also like to talk about is the notion of legacy planning as well. And legacy planning is something beyond just the traditional estate planning, whereby legacy planning, you're looking at ways that you can donate money to causes, or you're looking at ways that you can get money to your kids or grandkids now while you are still living. And what form does that take, and how do you do that? And if it's, for example, paying for college, how do you do that in the most effective way so that the kids can still or the grandkids can apply for the most amount of financial aid? Those are all sort of pieces of the equation that come into play that are certainly worth thinking about as you're thinking about your estate plan. So beyond just the estate plan, to think about the tax implications, to think about the legacy planning implications of that as well. Those things that you want to do while you're still on this good earth, and what form and how does that work, in fact. So certainly some things to think about as it relates to estate planning. We'll slide to the break. When we get back from the break, we'll continue the conversation. Dollars and cents. If you want to add your topic in our last segment, the numbers to call on in 407-916-5400. Toll free 1-855-545-1025, or the email, which is Joel, Joel, at NelsonFinancialPlanning.com. Those are the numbers to call on in and be a part of the program here on Dollars and Cents News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Good morning. Welcome back to the program, Dollars and Cents, here on 540 AM 102.5 WFLA. This is Dollars and Cents, and my name is Joel Garris of Nelson Financial Planning. We've covered a lot of topics on the program today. Frank's actually got a comment, and I will be happy to apologize after I read his email. So he says, I'm listening to your show this morning. It's quite clear to me that you have a disdain for our president. He does have a title and he does have an office. He isn't Trump. He is the president or President Trump. The tone in your voice for his pick, which I assume was the pick for the Supreme Court, was very, very disturbing to me. Well, Frank, first of all, my apologies on that. If you were disturbed by that, I think if you listen to our radio program over the years, certainly the most recent administration, the Obama administration, that's just how I refer to them. But your point is, in fact, well taken, that it is the highest office in the land and it does accord some form of respect. Certainly, it does not get the respect in the mainstream media. So certainly I can appreciate that comment, because if you knew me, you would know that, or knew me on a personal basis, you would know that the office clearly does hold a tremendous amount of respect. And I do think that there are some very strong economic positives out there that have occurred under this administration that did not occur under the previous one. I think you'd have to be living under a rock to not at least acknowledge that, particularly on the deregulation side, particularly on the corporate tax cut. I mean, that's the reality. And we are, of course, a financial planning company. So when you cut taxes for corporations, that's good for the market, obviously. And my comment on Justice Kavanaugh, he does have a record that is positive to business interests. So if you are an investor, well, then that's obviously a good thing. So we are positive on the pick. We try not to get into all of the various social issues that like to get people fired up on the program, because frankly, it doesn't really have anything to do fundamentally, in our view, with the economy or the markets or corporate performance. So we try and stay clear of all of those other hot button issues that are out there. But fair point, it is the highest office in the land and does deserve respect. President Trump. But again, I was calling Obama. So I guess I can, bug people on the left and on the right, which is, I guess, the point. What I've told is you want to be, if you really want to max out your audience, you want to be controversial and delve into those hot button issues. And, well, sorry, that's just not what we do. We're a little bit more centrist than that. That is for sure. But Frank, my apologies. Fair point. We will take that. We will accept that criticism and apologize. And thank you for listening to the program and reaching on out to us. Certainly, it's going to be a busy week ahead in politics and the earnings, as we were talking about earlier in the program. the week ahead is really kicking off earnings season in great demand, and the expectations there, really, when you stop and think about it, are pretty incredible. Certainly, the earnings expectations and the revenue growth is some pretty high numbers. Top-line revenue growth expected to grow at 8.4%. Earnings expected to rise at 20%. Pretty dramatic across the board. Also, was reading some statistics that look at the markets so far, and when you have years where the first half of the market effectively there's not much movement, generally that usually means that a lot of the movement happens in the latter part of the year. We've shared it in previous shows some of the statistics that look at midterm election years in particular. Let's not forget what this is. And some of that stuff is coming right up. I mean, if you turn on the television, I mean, it's all ads for governor. And that I think the party election, the primary stuff occurs at the end of August. So, I mean, that's like 6 weeks to go. And certainly that is right around the corner, which is why this morning in the short bit of TV that I saw, it was one governor ad after another. So that political year, particularly a midterm election year, historically, the markets have been quite flat leading up to the election, and then the vast majority of the return for the year actually occurs in the last few months of the year. So stay tuned on that. Certainly time will tell. In the meantime, you certainly do have some pretty strong fundamental economic data in terms of top-line revenue growth and, more importantly, much greater earnings growth across the board. So certainly an interesting economic dynamic set up largely by, we believe, three chief things, which is the corporate tax cut, the federal spending bill getting passed in February, and then, of course, just some loosening of the regulations that allow businesses a little bit more freedom to run. So certainly, if you're looking at it from an investor perspective, there's a tremendous amount of positives out there as we take stock in sort of the midpoint of the year. We do communicate with our clients on a regular basis, and so at the beginning of this month, so a couple of weeks ago, we did send out sort of our mid-year outlook, our mid-year review. If you're curious about what we said, we did post that on our website at nelsonfinancialplanning.com. That is in the segment that is actually the little button that says "From the Desk of Joel Garris." That's where we post that stuff. So certainly something, if you'd like to read that is out there as well. So like I said, a busy week ahead in terms of the earnings season. Make sure those topics that we talked about on the estate planning must, if you will, really think twice before you spend a bunch of money on a trust. That's really perhaps one of the most the best conversations I had this past week was with a local attorney, and we were talking at length about that. There are other ways to do it that are much more cost-effective and accomplish exactly the same thing. So, go use that method rather than paying a bunch of money, unless you just like spending money, just crazily, which I don't know anybody really does that, but so why would you? Anyway, we will wrap it up this week here on the program. We'll be back next week. You've been listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning, and you're listening to 540 AM News Radio 1025 WFLA.
This is Bud Hettinger. And you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
How have your investments performed over the past 5 years? Do you know? Are you happy with that number? At Nelson Financial Planning, we've been achieving investment results over the past 30 years using actively managed investments that we own personally. This is Joel Garris, and I invite you to review your investment results with us. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a conversation to review your investment performance. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 1025 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.